Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. We've got a half day of trading on tap today because obviously we've got the bank holiday with the 4th of July tomorrow. So this is going to be, the whole week has been a wonky week in terms of participation because we have a number of events that are important to watch, whether that be the ISM data that we've got, the PMIs, both manufacturing and services that we have this week. And then, of course, we had JOLTS yesterday, which was a pretty muted response. We had Powell yesterday, who actually put Friday's non-farm payroll absolutely front and center. So if you have not yet checked the free video that's over at the Simpler Trading YouTube channel, probably the very channel that many of you are logged into right now, check that out, because in that I walk through what the implications are for the data. Now, one of the common questions I get, and I think I got this one on Twitter, was, and I have a couple of notes here for our show, real versus reaction. Gang, I am never, ever concerned about what's real. And I think if we're looking to trade what's real, we're going down a rabbit hole that frankly doesn't matter. A lot of folks say, Rog, isn't the data manipulated? Isn't the market manipulated? Isn't the data not real? And let's say we say, sure, it's not, right? Now what? Do we quit the game? Is it not worth our time? Of course not. And we know that's not true. In terms of if it is or whether it isn't, we know that we can still play this game. So whether or not the non-farm payroll is real, or when people ask me, I said, what does it matter? Is it reacted to, right? So I don't ever concern myself with real versus reaction. I just focus on the reaction. And all we do have is that data. And all the Federal Reserve will do is point to that data, cite that data, use that data to make their next decision. So when we have something like non-farm on Friday, of course it's important, but I'll never get caught up in the real versus not. Who cares, right? So we're going to trade that reaction, and that reaction is absolutely going to map to whether or not we are likely to see rate cuts in September. November and December aren't as reliant on it because, it's further down the year. We'll see how jobs and inflation go. But Powell said two really important things yesterday that in terms of rate cut implications, that one, they see some progress in terms of inflation. Again, what they view as inflation and the world that we live in are two different things. So those two things don't matter. It's just, what does Powell think is happening? And he did say that they would react to disappointing jobs, which is to say, if there are fewer job openings, there weren't. Yesterday's JOLTS number was pretty good. And if non-farm payroll is a miss on Friday. So we are still in this world of good data is bearish. Good meaning strong jobs, more jobs, lower unemployment rate. That good is actually bearish to equities. But bad data that would tell the Federal Reserve that we are staying too high for too long on rates would compel them to act. And he pretty much said that. So ultimately, what we want to remember is whether or not things are real or manipulated, whether or not they're gunning for our stop, gang, it's maybe always been, but I will say equally, it doesn't matter, right? So that's what we've got coming up. We can only look at the data we've got, see the reaction, and trade accordingly. And the fact of the matter is that real versus not is oftentimes a very common conversation that's made in terms of, the equity markets are overextended. Okay, now what? Short that? I mean, imagine starting off the year saying the equities are overextended and PE ratios and whatever else is often cited. And someone says that's the justification. Markets should be lower. They shouldn't be anything, right? You can basically should all over your trading account and you'll miss what has been an epic year, mostly in tech. I won't say the same thing about the Dow. I won't say the same thing about the Russell because the high concentration weighted sectors in those two just haven't been performing. And yeah, I'm talking about financials and regional banks, but tech has been in fuego. Look at XLK, look at SMH, look at XLC, and even more recently, XLY. So as long as those four sectors, think of them as cylinders in the motor of the NASDAQ, are firing away, That's just where it's going. So it's not a matter of questioning why we are where we are. It's just trading what we see, not what we think. Trading what we see, that's going to lead to likely, I think, good trading. Trading what we think, just that's analysis. That's the garbage on television. That's the opinion pieces. That's analysis. Um, it's not just bad advice. Usually, it's an opportunity cost, right? So a lot of traders will email me and say, "Rog, I've missed the trend," and sadly, I have to say, for the first 6 months, yeah, you have. However, trends aren't going anywhere. We might chop around maybe in the latter part of summer, but we should, based on the data we see, finish the year strong. So let's stick with what we see, not what we think, because what we think is oftentimes going to create an opportunity cost of just missing things that are rallying for, no good reason, but yet they are. Okay. All right. So as always, I thought I'd put a little agenda there in the notes. So Friday's data, real versus reaction, rate cuts are still very much on the table. And this holiday week trading has been a little tricky for day trading, I will say. One of the things that I'll do not only today, but going into next week is I'll probably focus a little bit more conservatively on my hourly price movement ranges, my volatility-based support zones, even if there is a trend. It's really, once again, on the day trading side, lending itself very well to those support and resistance zones based on historical volatility. What are the trends to watch? Well, we just named them: NASDAQ, XLY, XLC, SMH, XLK. If you are a member of the Sector Secrets Mastery or even the Simpler Central Room, yesterday's premium video, I went through a thorough watch list of not just those 5 sectors, but what within those 5 sectors, really a scanning stock picking session where if we get a pullback on Friday because a non-farm payroll number is huge, then we definitely want to focus on some buy the dip. And the very last symbol that we talked about was crude oil, right? Crude still remaining strong. It's not a trend, but it's still remaining over $80. In fact, it's remaining over 82. And we want to keep an eye on oil stocks. And the two that I'm most focused on, I think we've talked about in Charts and Coffee: Occidental, Schlumberger, and even buying crude itself. All right, so let's get to it. Let's grab some questions here. And first up is Jay Silvestri asks, where can I download the correct charts with your color-coded uptrend, downtrend boxes on TOS? I feel like mine are from years ago. They probably are. If you're a member of the Sector Secrets Mastery, the classic layout is in the files drive. And if you've taken the recent Top Tier Pro class where we've released a brand new set of candles, set of the brand new calculation for the wave and a number of other things, you can check that out as well. But most of what you need is in the files section of the Sector Secrets Mastery Room. All right. Next up is, we are trading in the matrix. Exactly. Right. It always does crack me up because, look, I'm not the one at the helm of the Federal Reserve controlling interest rates, controlling money printing. They're the ones. So the only reality that matters is Powell and companies. And they're the only macro fact, frankly, that matters. I'll tell you, I was in Oregon years and years ago. Oregon's a gorgeous state. I was in Bend, Oregon, and I was speaking and I was thinking the whole time, why am I here? I mean, these were folks who wrote newsletters for hedge funds and ran macroeconomic sites. I'm thinking, why am I here? But cool, I'm one of the speakers. I think there were about 6 of us, and everyone. And this was in 2018, or I think this was in 2018, and everyone there had chart after chart after chart of why in 2018 we were setting up for another. Literally, they were citing things like the Black Friday. They were citing things like major market crashes and all the reasons why we were supposed to crash. And I thought, and I stood up there and said, look, these are all very smart people. They're showing you data why we should be lower, but we're not. We're not lower. These are pretty good trends, and this is where the support is, and this is where yields are, and this is what the Federal Reserve's doing. I was the only voice in that room during that whole time. And I sounded like a crazy person saying, look, it doesn't look like we're going to have any kind of significant crash. And I think this was before Powell, I believe this was before Powell hiked one more time. And I said, dips will be buyable. We're not sure what monetary policy should be doing, but Powell should be pausing soon. And yeah, Powell created the volatility. And then look at what happened the following 2 or 3 years. So this is where I always say when folks want to get your attention, they're never going to say the markets are moving higher. It's not an attention grabber, right? They will say the markets are going to crash. The markets are going to correct. We're going to 5,000, right? That's what gets people's attention. And yet, so that's, it's the same. I keep hearing the same thing now. Oh, we're due. We're not due for anything, right? If you say, but Rob, what about April? We talked about April. This is when 3 Fed members started talking about rate hikes, and it upended the conversation about rate cuts until Powell said, nah, we're not hiking. And then what did we do? Started marching higher again. All right. So yeah, it's very much the same thing, but it just never stops, because if you want to get attention, say something scary, right? Because it seems, and I'll tell you, there's a big difference between sounding jaded and bearish. And we've confused bearish in an uptrend with some sort of insightful wisdom and fortune telling, right? Anyone who's bearish right now, really, when they're on the television, I wish the commentators would say, but gosh, Mr. Bear, Miss Bear, but you've been wrong all year. Can you comment on that? Never is that asked, right? So let's just follow the trends, gang. But let's make sure that we're not looking at names that we're hoping will rally. Let's focus on names that are in a rally. And that does bring up one more thing. And I'm just waiting. If y'all have a question, feel free to type it in. We are now within about 9 days to the kickoff of earnings season again. Yeah, it's back. And you'll see financials seem to be waking up. If we continue to see strength in financials, XLF, JP Morgan, Bank of America, and Citi, those are my 3 favorite right now in that group, it will benefit the Dow. So if you're waiting for the Dow, saying, what gives, Rog? How come the Dow really isn't in the same way participating? Because the Dow's weighting in the sectors that are in fuego right now is far less. And the most heaviest weighted sector in the Dow industrial average is, in fact, not industrials, but this thing, at financials. So financials can wake up and we can start trading above, say, 42. Look out, the Dow is definitely going to start to benefit. But we're seeing financials moving because there are a number of stocks within it that are starting to move and groove in front of their earnings release. So make sure you've got a good heads up, right? Not the week of, not the day of, but weeks and weeks in advance. Okay, these are the stocks that could be moving because we're heading into earnings. Look at JP Morgan. It just suddenly woke up, and it's the proximity to earnings that's waking it up. All right. Let's see. Questions here. You know what, Yee? I have only landed in Portland and gone out to Grants Pass. I think it was Portland we landed in. And yeah, I've never spent time in Portland. I've been in Grants Pass for about a week, and I was in Bend for about 4 or 5 days. Yeah, I've never been to Portland, but it is a cool state. It is I remember when I was out in Bend, everything wound down around 9 because everyone wanted to go to bed early. That suit me just fine because they want to get up and hike or whatever, bike. That was really cool. So definitely my kind of place. It's gorgeous out there. All right, John asks, real estate stocks, once rate change from the Fed, could see a nice upside. Yeah, it's interesting, John. I've been keeping an eye, not so much on things like VNQ or XLRE, but let's take a quick peek at them. So here's what, look, not everything's going to be in a trend right now. So great question. What I want to know is, have things like VNQ, XLRE, ITB, XHB, have they recovered enough to start to look like something that's at least neutral or bullish? And I can't say ITB, that's home builders and home construction, but when you look at XLRE, things like that, and I don't know specifically if you're looking at a home builder or a sector, but however you want to break it down, those 4 symbols are a good way to do it. What I do like is we're starting to compress, and much like a can of Coke that's been shaken up, or a toothpaste tube that's about to be squeezed. This is the kind of action that I would anticipate. This compression of a wider range. Look at the Darvis to a slightly narrower range. And we just continue to get a little bit more neutral. And a lot of times, for those of you that like chart patterns, I don't use them. I used to a lot more than I do now, but I like the automated Darvis because within this, yeah, you can envision there's a larger compression in terms of a triangle that's happening. The bottom line is I don't want to wait for the breakout. What I'd rather do is find a neutral environment, buy the support, and then anticipate the breakout. That way, if we don't break out, if price does not run stops through the resistance level, I've at least got a target that I could scale out at. And so it's a very different way of trading momentum. It's really more of an anticipatory momentum environment where I'm not just arbitrarily saying, hey, we could break out, but rather saying, look, there are factors that would get this on our attention, but just it's slowly starting to compress. And prices can't stay sideways forever, although they can go sideways for a long time. So rather than waiting for the breakout, which could be a whipsaw, I would like to focus on support levels and then use the opposite end of the range as a target. XLRE would be a really good example of that. And yes, if we're above the 200, the white dots, which I consider the equator, we're in that bullish hemisphere. I'd like to see more green candles as a general rule, but I would look for something like a breakout, like a nice compression to expansion move in XLRE. Ryan asked, we take a look at CORZ. All right. Nice uptrend. It's going through $10. So I'll say this, Ryan, anytime I'm looking at something that's under $20, I have found that volume is the most important thing. Let's pull it up on TradingView. And then what I'll do is I'll anchor it to last quarter. We can anchor it to the beginning of the year too. So if you're going to look at some volume, I would anchor it to either the first trading day of the year, or I would anchor it to the first trading day of the previous quarter, Q2. Now, where is the point of control? Where are different volume ledges? What gets my attention is 8.25, right? That gets my attention. So then let's look at the year. Okay, now I'm anchoring the volume profile to the beginning of the, well, actually, no, this is the born on date, Jan 24. Okay. So this is where Core Scientific starts its data. It's still about 8.25. It's still about 8.25. So that's where we bounced from. A lot of volume there at the mean reversion and that Darvis support. So what I would say in this case, maybe something aggressive, just to right around 10. But this is really just going to be a volume conversation. Now, the other thing we could do is open up the hourly chart and look at the hourly, because maybe what I don't have with some proximity now, I could turn into a shorter term setup and maybe look at this area around 10. Because if you go back to, say the end of April, look at the point of control. So that's been the most volume in the last roughly, let's call it 10 days. And so depending on your time horizon, right? Depending on how long you want to be in this position, the time frame should reflect that, right? So that's where I would focus on either a 1 hour swing where it's maybe a 2 to 3 day time horizon, 1 day even, or a daily time frame where I'm looking for days, if not weeks. All right, gang. So that is our show. Tomorrow, I think I'm going to go live tomorrow and do a charts and coffee. I mean, it's Independence Day after all. What a great theme for traders, because that is why we trade, right? And so tomorrow, I'll see you all at 9 o'clock. Bring your questions. We'll do a show tomorrow, and then we'll enjoy our day off. Remember, today's a half day, likely to be a very wonky day. I'm likely not going to be slinging much, maybe managing some positions going into Friday, tightening up some stops on July 5 expiration positions or positions that are in an unrealized profit target that I may not want to see unravel with NFP. So Java, it really depends on where that trade is in perspective to its stop loss and or target. And of course, focusing a little bit more on managing the contracts that will expire on Friday. All right, gang, be good to each other. I will see you tomorrow.